Good afternoon. I'm Dave Wheeler with Hartman Income REIT, and welcome to our webinar, Outpacing Inflation with Suburban Office Investments. Let me give you a little brief bio on myself. I graduated from Texas A&M with a civil engineering degree, concentration in construction management, then went on to did a master's of business administration at SMU in the mid-'80s. I joined CBRE for about 16 years. A couple of years as the regional investment analyst based here in Houston, another 14 years in North Dallas in investment property sales throughout the region. In January of 2003, I joined the Hartman platform. At the time, we didn't own any properties outside the Houston area. We've expanded significantly in terms of our geography and the scope of our portfolio. Let me move through the slides and give you a few more basic facts about the platform and the firm. We have 5.1 million square feet of office space, a little over 1.2 million square feet of industrial, and about 1.7 million square feet of retail space within those three markets, three MSAs, Houston, DFW, and San Antonio. Next slide. Mr. Hartman started the business in the early 80s, 39 years ago. That portfolio is now comprised of 8.1 million square feet, a little over $800 million in assets under management in 27 programs over that time frame. So the bulk of the platform, about 2/3 of it is office. Most of the rest is shopping centers, and there's about 7% of the platform by net operating income that is industrial properties. Those are in Houston and DFW. So that's kind of a platform overview. And I'd like to just start off with a few comments about inflation and suburban office investments. The first thing I want to mention is we provide protection against inflation in a number of ways. One is asset value growth, and the other is expenses. If you'll look at our first slide here, there's a comparison that NAREIT did between the performance of real estate investment trusts in inflationary times versus the performance in moderate inflation versus high inflation and low inflation. So what you'll notice is publicly traded REITs have historically outperformed the S&P, whether it's moderate inflation by about 3% or high inflation by about 5%. So that's noteworthy right there. A significant portion of that we would attribute to the income coming from these properties that helps outpace inflation, but there's also the growth aspect of the hard asset, its value growth over time. So what I would tell you is in our platform, expenses are passed on. The majority of the expenses are passed on to the tenant. So to the extent we receive increases in expenses on our properties, we can pass those on to our customers. The key attribute or the key thing that we need to focus on is controlling those expenses so that we're competitive against other owners and make sure that those expenses are kept at a reasonable level and what's being passed on is deemed competitive in the marketplace and may actually give us a competitive advantage. The other thing to think about in terms of inflation protection is the hard asset. So as inflation takes off, construction prices, replacement costs of properties, and land values continue to move northward. What that means is the rents to justify new construction move higher and higher at an aggressive rate. And when that happens, you'll see the rising tide lift all boats. Rents, or you need more rents to justify new construction. And when you get into that situation, you see less construction. Therefore, the available supply reduces, vacancies go down, and rents start to rise. So that rent growth component, as a result of inflation, will facilitate investment performance and valuation increases. So that's kind of how inflation impacts us in a nutshell. Let me talk a little bit about the different vacancy rates across different classes and the different capital flows that we see into the different property types in commercial real estate. So what we noticed in the early part of the pandemic was capital flows were heavy coming into industrial and multifamily, most specifically industrial. Everyone recalls that e-commerce took off, that we were at our houses ordering lots of things as opposed to going to the retail stores to pick them up. Well, that trend continued dramatically throughout the pandemic and is still relatively alive in the industrial space. In the multifamily space, it was largely the result of undersupply of single-family homes for the better part of a decade. So those continue to perform well, whereas office and shopping centers, in terms of interest and demand, fell off from an investor standpoint. They've come back. They've come back significantly. Shopping centers came back quickly last year, and hotels even came back. There are also other certain investment classes like data centers that received an inordinate amount of money as the cloud computing took off, cloud activities took off, and folks were online more and more. What I would tell you is that in the office space, the work from home phenomenon was meaningful, especially for corporate America. In our tenant base, we saw a quick return to the office, and we'll touch a little bit on that more later. Some of that is a result of us having small tenants who are more decisive, who are ready to come back into the office and didn't have HR or legal departments kind of throttling their return to the office. They wanted to get back in, they made decisions quickly, and they executed on those decisions quickly. So we saw them return to the office quickly, and therefore performance for owner-operators like Hartman was significantly ahead of what all other office owners observed, in large part because many of those owner-operators are in the A space. They're waiting on corporate America to make decisions to come back in the office. Corporate America, the larger corporations, were very slow and relatively reluctant to come back. We can talk a little bit about the trends in that underlying return. So you're going to have some folks staying and working from home on a regular basis moving forward. You had some of those before the pandemic. There'll be a little bit of increase in the long term. But when you think about the hybrid model that's developing, what you'll notice is it really isn't going to impact over the long run negatively office space. And here's the logic behind that. The corporations have to provide in their space for peak occupancy. And they have to have co-working space now because that's the way people like to do their work. They like to collaborate, they like to gather in conference rooms, and they like to gather in open spaces wherever those are. So you're seeing a move towards de-densification in office. So it's our expectation that as development stays throttled over the next 2 to 3 years for many reasons in the office space, occupancies are going to continue to take off and rent growth will continue to take off. It's why we're as bullish as we are on the office space. So let me talk a little bit about the rising interest rate environment on commercial real estate and how that's impacted us and how that's impacted suburban investments. What I would tell you is we compete with a number of local and regional sponsors, and they actually require a bit higher leverage than we do to get transactions accomplished. So debt is ubiquitous in the commercial office space and the commercial real estate space. Almost all owner operators use it, especially those that are below the largest of the institutions. And therefore, it's somewhat painful to all of us when debt costs rise. But here's how we mitigate that. We mitigate it first by keeping our leverage level about 15 to 20% below our competitors. Our competitors are often at 65 or 70% leverage. We're at 50% leverage. That's our target goal when we acquire, and we seek to stay that on value as we move forward. So it's less painful for us, and it actually gives us a competitive advantage when we're acquiring assets because we're not using more high cost of debt. We're actually able to get favorable interest rates on a relative basis because of that low leverage point. The other thing I would emphasize is while we often acquire with floating rate debt, it's not long before we stabilize assets and we put them on fixed rate permanent debt and therefore control the variability of our interest costs moving forward. So we're actually beneficiaries relative to our competitors in a rising interest rate environment. So yeah, let me talk a little bit about the shift in investment capital towards the Sun Belt, more specifically towards Texas. So I think everybody knows job growth has been very, very robust here in Texas. Job growth has been relatively strong in all of our major MSAs, and relocations into Texas have been strong as well. What you have to think about and realize is not only is corporate America coming here and bringing their workers, you've got unattached workers migrating to Texas, looking for jobs, knowing that there is job growth locally. So you've got expansion in residential real estate, you have commercial real estate services to provide to those residential, to those homes. And you've also got office space and industrial space demand increasing. So across the board, we see increasing demand. We see a relatively diverse economy here in Texas. And we also see the return of growth in the energy space here in Houston specifically, that's really playing strongly into the results in our platform. So the investment spigot turned aggressively towards Texas last year. I think many know that DFW was actually received the largest amount of capital across the nation in terms of all commercial real estate investment. It's the first time in the history that a major MSA in Texas has been the most sought after and the most highly invested in market in Texas. It's largely an attribute to the infrastructure that we have here in the state, the success of our secondary institute, our major universities, our major airports, all of our railroad infrastructure and inland ports, both in Houston, DFW, and San Antonio. They're all strong. Folks realize that a lot of goods come off the West Coast or shipped by rail to DFW, and that's one of the reasons we've had such a rapid expansion of e-commerce in Texas, in Houston, and Dallas specifically as a result of those inland ports. So Texas has received an inordinate share of capital coming in recently. We see that trend maintaining. It also continues into the international capital space. We see Latin America showing strong interest in Texas moving forward, and we think that's going to continue. So let me talk a little bit about office space. One of the questions we get is about flight to quality. And what I would tell you is flight to quality is true, but it's largely an A-space phenomenon. It's what's happening in corporate America. And it's the larger tenants, the full floor users and above in the S&P 500 of the major corporate organizations that are looking for the highest quality A space, trying to attract the highest quality employees and talent pool. What we have in our portfolio is a lot of small to medium-sized tenants, and they're not interested in paying $60 per square foot in occupancy cost to seek the highest quality buildings, the brand new, the newest shiny penny, the platinum LEED property that has the highest energy efficiency. Our tenants, the small office users, the mid-sized office users, are most focused on flight to value. And what creates value within our platform is move-in ready suites. We have three different kinds. We have traditional move-in ready suites, which are 1,000 to 3,000 square feet. Those will be multiple offices, a conference room, and all the facilities necessary for normal office operations. Those have traditionally done well for us. There are key reasons why we had almost 1 million square feet of additional leasing done by the firm within our platform last year. The other two move-in ready components that are noteworthy are newer additions to our platform. One is our biz suites. These are the suites that accommodate tenants that are under 1,000 square feet. Many of these are single offices, and they're priced competitively in the marketplace for people to come out of the house and find a place to office on a regular basis without spending tremendous amounts of money. So those are very popular. We also have small consulting firms, small therapists, and other firms that like those suites. In addition, we have our shared amenity spaces where you can rent office and then share a large kitchen, share a series of conference rooms. That's beneficial because you have access to more shared amenities than you would if you just had amenities in your individual space. So that creates flight to value for us. And it means that a lot of these small to medium-sized tenants find our B space is more valuable than others. They're move-in ready. We provide the services to keep those tenants happy and drive retention upward once they're in. So that's our addressing of flight to quality. It is relevant across the country, but what we find is also in the flight to quality, many of those buildings are harder to get to, and we're accommodating companies and employees in the suburbs that don't want to drive 30 minutes, an hour plus to get to the urban districts where the highest quality newer properties are. We're accommodating employees and businesses that want to be 10, 15, 20 minutes away from the office. So that flight to quality A space is meaningful, but it isn't impactful in the small tenant space. It's flight to value, and that's what really matters. In terms of our space, key amenities are kind of the ones you would normally assume: a fitness facility, conference rooms, food and dining option, kitchens, and that's what really makes the spaces attractive for the users that we accommodate. Few questions about office utilization have come up over the years, especially during the pandemic. And I want to refer back to something I mentioned earlier, and that's the Castle data. If you look at the Castle data, this is a firm that tracks entries into buildings by the security cards. Castle actively provides security for a significant number of the office buildings out there in various markets across the country. And they run a comparison on a weekly basis, and they have for years. And what you'll notice if you look at this chart is Austin, Dallas, and Houston, the major Texas metros on this chart, are well ahead of the rest of the country. There's really no other markets that show the level of activity and return to the office that these markets do. So we're achieving office utilization rates now and have been achieving for years since the pandemic started, well in excess of what those other areas are seeing. It's one of the reasons you're seeing users move from those markets like New York or San Francisco to Texas, is because we're less reliant on mass transit. Oftentimes, even though it's a car commute, it's a shorter one to a suburban office space as opposed to a longer one using rail. Mass transit is not nearly as popular as it was pre-pandemic. We don't see it returning to its level of popularity for quite some time. And therefore, the ability to commute on short commutes is going to drive a lot of office tenant demand moving forward. So that's office utilization. Let me see if there are any other key areas that we want to address this morning before we move into the questions. Yeah, another key question that's come up often is, where do we see the opportunities in suburban office investing, and what drives these opportunities? So I would tell you that we do occasionally see some foreclosures and some distressed owners within the B space where we invest. What you'll notice is there are just a number of owner operators that cannot marshal the resources or are unwilling to marshal the resources to be competitive moving forward. Those folks are often distressed that they're at the end of a fund life, or their performance has slipped far enough where they're not even able to make debt service payments, or they just lack the capital to turn the property around because they need to spend capital on tenant improvements, they need to spend capital on building improvements, and they need to spend capital on leasing commissions. So we see on a regular basis about 600 to 1,000 properties per year. We quickly bake that down to about 75 to 100 that look interesting. And within that grouping, we can almost always find on a regular basis a steady stable of distressed opportunities from owners who are unwilling or unable to turn their property around. So we see that trend maintaining itself for a number of years in the forward. We're optimistic about buying opportunities moving forward. And let me just see if there's any questions out there from the group. I've got a few more I could answer, but if there's any questions from the group that I can address, I'd be glad to do that. All right, first question. As a value add sponsor, how do you control your costs on tenant improvements? Well, the key thing to think about is as we're creating move-in ready suites into our properties, we control those costs in part because we control the timing, in part because we control the layout. So when you're accommodating a tenant who wants a space built for them, we call that a build job. You're under their direction. You've got to accommodate their desire. You've got to build the space to their demand. But if you're building the suite in advance for a small tenant, you're going to get to control the layout. You're going to control contractor selection. You're going to be able to put contractors in competition, and you're going to be able to drive that value into the space and create a value engineered proposition that allows for the optimal capital investment into the property instead of what the tenant wants on a build job. We talked a little bit about work from home and hybrid model, and I think I'll return to that just momentarily and state that the hybrid model really doesn't present any challenges for office space demand, because owners, landlords, and corporations still have to plan for peak occupancy. I think I'll just close by saying that here in Texas, we're quite optimistic about the future of the economy here. We see it as a bellwether state for many years in the past and many years moving forward. We believe that the major metros are going to continue to thrive. If you're paying attention to the press, CoStar just released a report that San Antonio actually had the biggest population growth of any major city in the United States last year. It's symbolic of how well Texas is doing, and we're optimistic about that moving forward. So I want to thank you for joining me today. I want to thank you for your interest in Hartman Income REIT, and we look forward to visiting with you again in the future. Thank you.